Hello guys, this is the trading journal for Friday the 29th of January from Vertical Spread. My name is David and I'm also known as the Spread Doctor. The sell-off in the equity markets continued today and the markets paid very little or no attention whatsoever to the stellar earnings announced by the likes of Apple. All the major indices were down by another 2% and GameStop took center stage yet again. And now the mark-to-market losses for the shorts in GameStop for the month now stands at 20 billion. That's 20 billion with a B is how much the shorts have lost in GameStop just in January. But they're not surrendering, they're not giving up, and the short squeeze continues. Today being the month end probably attracted some strategic selling for tax purposes, and the nervousness in the market is leading to some profit taking in some names that have had a very good run up, and that can be one of the reasons why Apple was down. Yes, it was down yesterday about 4%. It's down another 3% today, in spite of it announcing one of the best quarterly earnings ever and announcing one of the highest number of upgrades in China. So it just looks like people are not trading on fundamentals. Volatility is high, there's nervousness, there's uncertainty, and people are buying protection. And that moves me nicely onto the VIX. So the VIX was up 9% today to close at 33.09. And that speaks to the nervousness in the market. So there was a lot of downside protection buying today, a lot of puts buying, and that pushed up the value of the VIX. There are now 21 days until the February contract expires, and there are 49 days until the March contract expires. In terms of trade ideas, I had no new trade idea today, and none of my positions closed out today. And before I move on to my open positions, I would like to say a word or two for the new members about the strategy of selling premium. I'd like to talk about trading in general, trading psychology, and managing expectations. Firstly, before I dive into it, I tend to use the phrases selling premium, selling vertical spreads, and selling credit spreads interchangeably, and they refer to the same thing. Now, when I sell a spread and collect premium, the position is designed to make money on theta decay. And the ideal situation for that position is for the underlier to go up a little bit or go down a little bit or stay flat. So for example, if I sell a put spread and the underlier makes a massive delta move upwards, my position will suddenly flash a big positive P&L. This is not an ideal situation. Even though my P&L is positive, it's not ideal. And that is because the underlier could easily swing around and make a massive move downwards as well. So ideally, the P&L should accrue by small amounts over the life of the position until maybe just over a week before the options expire. In other words, a theta decay should gradually erode the premium I collected on a daily basis. The massive swings in P&L caused by massive delta moves are not the ideal condition for my spreads. So trading spreads and trading in general can be broken into three parts. You've got the open, when you open the position, you've got the management of the position, and you got the close when you close out the position. All three are equally important, and the mindset of the trader plays a crucial role when it comes to managing a position. There are times when one has to manage an open position, and there are times when one has to do nothing. And I I personally see selling premium as a passive strategy, a passive income strategy, and I largely remain passive throughout the duration the position is over. What I tend to do is I check my position at the open, at the market open, and I check it at the close. I do not keep an eye on them intraday. I don't keep on checking my P&L intraday unless I'm looking to make an adjustment or maybe I'm looking to open a position. I simply leave theta decay to chip away at the premium received. Also, I do not get elated when there is a massive delta swing move that creates a massive positive swing in my P&L. And likewise, I do not get deflated when there is a massive delta swing the other way that creates a massive negative swing in my P&L. I tend not to talk about intraday moves in my P&L in the forums. I try to only talk about my positions in my journals when I review them. Now, if someone poses a question or posts a comment about an open position in the forum, I will respond, but I tend to shy away from being elated or deflated about open positions. And that's simply because emotions do not help either way. So I try to remain flat, if you like, or constant. I try to divorce emotions from my trading. I don't count my chickens before they hatch, because a position which is a 30-day position shows a massive P&L on day 5 makes no difference. You know, what really matters is when the position closes, not what it does in the interim. I know that the strategy generally has about a 70% chance of success. That is selling premium credit spreads. And my last year trade ideas produce an 88% success rate. And I know that any individual trade can be a loser. However, in the long run, the strategy will make money. That is what I keep at the forefront of my mind, and not the intraday swings in my P&L. And now I'm going to move on to my open positions. I now have 4 open positions and 1 synthetic position. My open positions are in TAN, ZYME, FOLD, PLUG, and I've got a synthetic in QCLN. NVCR closed out, I think week before the last. So I'm going to start with TAN. So on TAN, I sold the 105-100 put spread for a credit of $1.42. My short put is the 105. Let's see where TAN closed out today. So TAN closed today at 108.69, implied volatility 51.5. My short 105 put is currently out of the money, and no action is required on this position at the moment. In terms of my P&L for TAN, I currently have a negative P&L of $45 per contract. So negative P&L for $45 per contract. It's showing 420, but I sold 8 contracts, so that works out negative $45 per contract. But my short strike is not tested yet. No action is required on this position. The next position is in ZYME. On this one, I sold the 45.40 put spread for a credit of $1.08. Let's see where this thing closed out today. So ZYME closed out at 33.82, implied volatility 42. My short 45 put is now deep in the money, quite deep in the money. And although I would like to make an adjustment to this position, however, the market makers have widened the bid-ask spread on the calls so much that it makes no sense for me to adjust it now. So what do I mean by that? Let me look at let's go to the option chain. So I'm going to go to the trade tab, And this is ZYME. This is the Feb contracts, which I sold the put spread in, and we've got 20 days to go. So it closed at 33.82. I'm short the 45 put, and I bought the 40 put as a hedge. What ideally I would like to do would be to convert it into maybe a covered straddle. So sell the 45 call and buy the 50 call. But look at the bid-ask spread for the 45 call. I can sell it for 20 cents, but buy it for 105. Now that makes no sense whatsoever. They've widened it so much that it makes no sense for me to adjust this position at the moment. And if I did want to go ahead and adjust it, I would sell the 45 and buy the 50. But that would give me a credit of 25 cents. So it's not enough credit for the risk being taken. It's a $5 widespread. I'm not going to sell it for 25 cents. So on this position, there is nothing to be done at the moment. There are still 3 weeks until the Feb contract expires, and this is where the passive income comes into play. Simply going to sit on my hands and wait to see what transpires or what develops next week, and see if I can adjust it and take it from there. The next position is FOLD. On FOLD, I sold the 1914 put spread for a credit of $1.88. Let me see where FOLD closed today. Actually, before I move on to FOLD, I didn't talk about the P&L on ZYME. On ZYME, I've got a negative P&L of 270 per contract. So it's showing negative P&L 2160 here. I sold 8 contracts. That works out at negative $270 P&L per contract. Now I'll move on to FOLD. On FOLD, sold the 1914 put spread. FOLD closed at 1891. My short 19 put is about 9 cents in the money. I actually like the price action in FOLD, and I'll pull up a chart of FOLD to show you what I mean. So this is a 1-year chart of FOLD. Today the sellers pushed it as low as 1861, the short wick at the bottom of this candle. So this is today's price action. Sellers pushed it as low as 1861, and then going into the close, the buyers came in and bought it back up and closed it at 1891. Now, in a market environment that has been selling off for the past 2 days, the buyers have been coming in at the close for the past 3 days and buying this thing passively. So here you can see the small wick. You can see how low it went there and how low it went there, and then it managed to close it around here, close it around here, close it around here. So that is encouraging, and I like the price action. My short strike is about 9 cents in the money. No action is required on this position for the time being. I'm not looking to make any adjustments on this one. In terms of the P&L, unfold, currently showing a negative P&L of 196 for the entire position. That comes out about $24.50 negative P&L for fold. But like I said, I'm not looking to make any adjustment on this one. We still got 2 weeks to go. I like the price action. I like where it's sitting at the moment, and if the market was to, if today was the expiry date, this negative P&L would be positive. And moving on to the final position, it's in PLUG. On this one, I sold a 55.50 put spread for a credit of $1.92. Let's see where PLUG closed. So PLUG closed at $63.17, implied volatility 59. My short 55 put is out of the money on this one, and in terms of my P&L, PLUG plug is showing a P&L of 412. That comes out positive P&L of $51.50 per contract. Like I said, my short 55 put is out of the money and no action is required on this one. The final position I'm going to cover is one I haven't got a position in, synthetic position. Someone in our forums has this position on. QCLN selling the 77.72 put spread for a credit of $1.55. Let's see where QCLN closed today. So QCLN closed at $79.87. IV 81. The short 77 strike put is currently out of the money. And I haven't got a position on this, so I can't tell you what the P&L is, but I can work out the mark-to-market position, so the mark-to-market P&L for this position and see what the P&L is. So QCLN, if I go to my trade tab, and it's selling the 77 put and buying the 72 put. The mid close 165. It was sold at 155, so that works out negative P&L of $10 per contract. Now, like I said, I have no position in this spread. The short 77 put is out of the money, no action required at the moment, but there is a big gap, or a gap to be filled at 78.90 for QCLN, 78.9. There's a gap to be filled at that level. I'll keep an eye out for that to see if the market makers push it down to 78.90 and then see the gap get filled and then move up, or whether it moves further down or whether it consolidates. But regardless, for the time being, the 77 short put is out of the money and no action is required. And that takes me on to my watch list. On my watch list today, I have got ARKK, SLV, ARKG, QCLN, PBW, TAN, GameStop, surprise, surprise, and XRT. I'll quickly run through them. So ARKK, SLV. ARKK. Currently trading at, or closed at 137, implied volatility 78.5. SLV is an ETF that tracks the price of silver. Silver has been on a tear. IV 61, silver close at $25. ARKG. $102 is where it closed. Implied volatility is 83. QCLN. Close at $79.87. Implied volatility 81.4. PBW. Close at $119. Implied volatility 63.5. TAN, which we have a position in. TAN closed at $108. Implied volatility is at 51.4. GME, which is GameStop, $325. It was a $9 stock 2 weeks ago. Implied volatility 77.2. And finally, I've got XRT. XRT, $88 ETF. Implied volatility is 82.7. And that brings me to the end of my journal for today. The main highlight is that the ongoing sell-off in the markets has pushed some of my short puts into the money. I'll adjust those that need adjusting when I do get an opportunity to do so. In the meantime, sit tight. We still have 21 days until the February contract expires. I hope you enjoyed listening to my journal. You can leave me any questions or comments below, and have a fantastic weekend. Thank you and goodbye.